Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So in the last 2 weeks, as we know, the markets have come down quite a bit, and that has given us quite a lot of opportunities, and we're not there yet, okay, but it has given us some opportunities to start looking again in undervalued stocks. The reason we always talk about undervalued stocks is because it's absolutely the perfect time to buy a company is when it's actually trading below its intrinsic value. What I mean by that is, you don't want to overpay for stock and later on it goes down because, the sentiment has completely changed, and for that reason you lose a lot of money. So what we need to do instead is just do your research, be patient, find out companies that are intrinsically below their intrinsic values or quite cheap and buy them and hold them for a long term. And that's what we basically need to do. And what I'm going to do today is we share with you guys 9 high growth companies that are either fairly valued at the moment or undervalued. So I'm going to share with you just a quick information about each one of the companies, and if you're really interested and you want to learn more about these companies, as always, do your research. And of course, my view on these companies might be slightly different to yours, and that's absolutely acceptable. And if that's your take on it, 100% you're entitled to your opinion, and just do your research and do what you need to do, because in the end of the day, it's your money and you need to be able to spend it wisely. So I'm going to share with you the 9 companies, like I said, just a bit of information. Of course, again, do your own research and so on. Now, it was interesting, a couple of weeks ago we were around here, greed and so on. I think it was the beginning of January, we were in extreme greed, but right now look where we are. We're heading towards extreme fear here, and this is where I start buying high quality companies. And and I'm going to continue doing exactly what I've always told you guys to do. I'm going to dollar cost average into the market by buying high quality companies, or what I think are high quality companies that meet the criteria that I set for myself, and of course you just hold them for a long time. So about a year ago we were basically in greed, and then basically about a month ago we were there almost to 69, and right now, as you can see here, we're here, okay? And the sentiment can easily change, okay? Just like that. So always be patient, always look out for high quality companies and so on. And now what's going to happen next week is a lot of the big boys are reporting, and that could potentially make things worse for us. So on Monday, there's not that many companies that are reporting, that in the huge, basically the mega companies, if you like. But then we've got UPS reporting on Tuesday morning, and PepsiCo is reporting on Tuesday morning as well. Then in the afternoon, after the market closes, Tesla is reporting, Visa is reporting, Texas Instruments is reporting. So that will be interesting afternoon to see what happens, especially with Tesla. If Tesla comes out and talks about anything negative, or Elon says anything negative, I think that this company could go back down at least to $200 per share. And again, I'm going to talk about Tesla in this video, so we'll talk about that in a second. Now, on Wednesday, we've got not that many companies that we own in the reporting, but we have Meta reporting on that day. ServiceNow is reporting, and the one I'm looking forward to is Lam Research, and see what they say, because based on what TSMC and ASML said so far, I want to see what they have to see. They basically say overall the markets and what they are doing right now. Now, Thursday, there's not many companies that we own basically that are reporting, apart from AstraZeneca in the morning, and then Microsoft, Alphabet or Google, Intel are reporting, as well as Snap and so on. So that will be in the afternoon, very, very interesting afternoon, especially Microsoft and Alphabet, especially what they have to say about AI, because they've got that competition going on between the 2 companies right now. So it will be interesting to listen to their call and see what they say. Then on Friday, basically we have before open, we've got Exxon, the 2 oil giant companies, and we've got Adobe as well reporting, and Colgate in that as well. So it'll be interesting to see in the next couple of weeks. Like I've always said to you guys, this gives us sometimes a great opportunity to actually buy high quality businesses and basically at discounted prices, because investors, retail investors, think, okay, it's the end of the world, and the company reported one bad report and all of a sudden it's a sell. So yeah, just look out for that. InshaAllah, let me know if what you're buying and what you're selling. And what I'm going to do now is just to go over 9 companies that I found on basically in according to Morningstar are undervalued at the moment. So let's get started. these are high quality basically companies. Some of them we've talked about before, some of them we haven't spoken about, but some of the things that we're looking for current price, we're looking for the EPS, we're looking for price PE right now, price to earnings, and then we're looking at the price to earnings forward. We're looking at the PEG ratio, which kind of helps us for basically higher growth companies. The PEG ratio, normally what we're looking for, anything basically just under 1. So a PEG ratio under 1 suggests that the stock price is not currently accounting for expected earnings growth, which is very interesting. So we also look at other things, like for example the profit margin. We look at return on equity, return on invested capital, the current ratio, which helps us to see if the company can pay off its debt and then basically liabilities in the next 12 months. Free cash flow is very interesting to see, and then total return in the last 10 years or 5 years, growth estimate for next year, then 5 years after that, and Morningstar valuation. Let's start with the first company, and that's Tesla. Like I said, Tesla, when you now go on any of these websites, you will see very, very negative headlines about the company. So this one is a strong sell. This is seeking alpha. This is a sell. This is a hold, sell, hold, strong sell, hold, and sell. Nobody has anything good to say about Tesla right now and the way things are. When they report on whenever it is, I think it was Tuesday, right? So when they report on Tuesday, we will see what happens. Now, if you're interested in Tesla, okay, as you can see here, it seems a little bit discounted right now. 478 billion market cap. Is a great, huge company. It hit, I think, $1 trillion, didn't it? Not long ago. I think it was November, October this year, was it? I can't remember exactly, but I'm sure it hit 1 trillion. And then it has a narrow economic mode, $147 per share right now. At some point, I think it was over 200 something. EPS right now, $4.30. PE ratio 34. Forward 56. Okay, that's probably explains why people are very pessimistic about the company. PEG ratio just 2.3. Again, that's not good because we're not normally looking for up to 2. I normally say it's okay, but anything above 2, it's quite basically overvalued. Profit margin right now 15%, return on equity 27%, and return on invested capital of 12%. Current ratio above 1, which is good. Free cash flow $4.3 billion. Total return the last 10 years 27% per annum, and growth estimate next year is 36%, then 15% after that. And if that's the case, then it's worth taking a risk. And I'm not saying go away and do that, but that's something I will be doing. Okay, so if you want to do that, that's entirely up to you. But I am a share holder of this company. If you want to see how many shares I own of this company right now, then go into the Patreon account where you will see basically where I will be sharing. Actually, at the end of this video, I'll be sharing basically my latest purchase of this company. Morningstar is saying right now is 23% discount right now. $195 per share is where they think the price should be. Right now it's only 147. So if you are long-term, basically a term investor, and you're thinking about the long term rather than just the 1 month, the next month, or what might happen, then and you know how good this business is, then it's worth looking into it. Okay, and I'm not saying go in and buy it. Please don't listen to me, but just do your own research. Adobe is the next one. $270 billion market cap, wide economic mode, $465 per share. EPS over $10. P ratio 44 right now, but forward is only about 26. Price. So PEG ratio right now 1.8, which is okay. Profit margin 26%, return on equity 35%, 32%, and return on invested capital of 36%. PEG ratio above, current ratio above 1. Free cash flow of $7 billion. Total return the last 10 years, we're looking about 23%. Growth estimate next year 13%, 12% after that. Every single year, 24% discounted, $610 per share. Is where they think the price should be. This company, because of what's happening with the AI, a lot of people are worried about AI taking a bit of a market share from this company. So will be interesting to see what they do. Of course, they have a Firefly and all of that stuff. They've said, okay, we're going to use AI to help us rather than just go against us kind of thing. So it'll be interesting to see what happens. But it is going through a transition and is a wonderful business. So, and we use their product on a daily basis. We would not be able to survive in our business without it. So it'll be interesting to see how it goes from now on. PDD Holdings currently has 157 billion market cap, narrow economic mode, $113 per share, EPS of $5.68. PE right now is about 19, let's call it about 20. Forward PE of 13, which is really good, and PEG ratio way below, so 1, which is very interesting. Profit margin 24%, return on equity 38%, and return on invested capital 30%. This is really good. Current ratio above 1. Free cash flow $11.5 billion. Total return the last 10 years, we're looking at about 40%, but that was only 5 years, so that's why I put start there only for 5 years. Growth estimate next year 33%, then 4% after that, which is weird, and then 47% discount right now. $213 per share is where they think the price should be. This is very interesting. This is really interesting. Almost 50% down from where it should be, and the fact that they have a real profitability side of things, it looks really good to me. Free cash flow is good. Total return the last 10 years are excellent. This year is okay, but the reason we just need to find out why it's 4% and not, at least to double digits in the next 5 years. Next one is Tyler Technologies. 17.6 billion market cap. It has a wide economic moat. $403 per share right now. $3.80 of EPS. PE right now 103. Forward PE 46, and PEG ratio above 2. Profit margin 8.5. Return on equity 5.9, and return on invested capital of 6%. Current ratio below 1. Free cash flow right now 327 million. Total return the last 10 years 18%. Growth estimate 14% next year, then 11% after that. 18% discount right now. $485 per share is where they think the price should be. Next one is one of the darlings of 2020-2021 boom. That's DocuSign. $12.2 billion. Narrow economic moat, $55 per share. EPS is just 0.535 dollars. PE right now 157. Peak forward PE though 18. That's absolutely crazy. PEG ratio just above and 0.5%. Profit margin we're looking at 0.53. Profit margin we're looking at about 2.6. Return on equity 8.5. Return on invested capital 5%. Current ratio about just closer to 1. And free cash flow 885 million. Total return the last 5 years 2%. Growth estimate next year is 8%, then 20% after that. So you gain 20% basically. EPS grows off every single year for the next 5 years, which is really good. 28% discounted, $80 per share. This is one of the companies that I'm not sure why some of the big boys, like for example Adobe, has not managed to purchase this company. It's only $12 billion. Although Adobe does have some of the things that this company does. It's interesting, but I always thought this company will be acquired by one of the big boys, but they still haven't. So Visa is the next one. It's only fair valued. Okay, we've talked about a lot of these Visa, so I'm not going to talk about much, but how it's a very high quality business. Fairly valued, $260 per share. Is one of the best companies out there. To see it basically being undervalued quite a lot is really good. And if we see another 5% drop in the market, and that can easily happen, because last couple of days some companies have been trading down at least to 5%. 1 week some of them are down almost to 10-something%. So we could potentially see that. So yeah, so next one that we're looking at today is ServiceNow. Again, it's one of the companies that's reporting this week. I think they were, if I can find them. There you go, ServiceNow reporting this Wednesday, so it'll be interesting to see what they say. Very similar to Salesforce, $158 billion. Market cap wise, wide economic moat, $13 per share right now. Over $8 in terms of EPS. 84 PE, forward PE of 58. PEG ratio above 2. So it seems a bit expensive based on the forward PE as well as the PEG ratio, but it's fairly valued according to Morningstar, so 770. They do have excellent free cash flow. Their profitability is actually good. Return on invested capital is not great, so it's only 8%, but that's okay. And then total return the last 10 years of 31%, which is absolutely huge. Next one is Autodesk, $48.8 billion of market cap, wide economic moat, $216 per share right now. PE, EPS, $4.19. Current PE 51, forward PE 28, PEG ratio above 1.5, which is not bad at all. Profit margin 16, 60% return on equity, 25% return on invested capital, which is really good. PEG ratio just below 1, free cash flow 1.7, total return the last 10 years about 17%, 13% growth estimate next year, then 12%, 17% discounted, $275 per share is where they think the price should be. And And finally, AMD. You didn't think you would see AMD in this on this list, but look at it. It's fairly valued. Apparently, it's $145 per share. Now it's 146. So it's on that line basically where they think it should be. So if it goes down again, another 4 or 5%, because I'm sure it's one of the companies that's down quite a bit. Let me just click for 1 week. It's down 10% for 1 week, and for 1 month it's down 18%. So for that reason, that's why probably it has come down quite a bit. So yeah, it can go down easily 5% on a day or a week or whatever, and if that happens, it becomes undervalued. Then again, if you're gonna have to take a risk, I guess, because this company in terms of EPS is not much. PE right now over 200 and forward PE 43. In terms of PEG ratio, below 1. So this kind of helps us, okay, understand what's happening with the company. So this is one of the things Peter Lynch used to look for. PEG ratio. Profit margin is not great. Return on equity almost non-existent, and return on invested capital non-existent. Current ratio is just fine. $1.1 billion of free cash flow, 44% return in total return in the last 10 years. And 52% growth expected this year, next year 25% every single year for the next 5 years. Fairly valued, $145 per share. There you have it. That's the 9 companies I want to share with you guys. You can have a pause the video and have a look in terms of Sharia compliance side of things. I've got a few more videos planned for you guys to inshallah I'm going to share with you guys in the next couple of days. I'll be a bit more active as in basically earnings come through, and I'm going to go through some of the earnings these companies are reporting, inshallah, some of the most important ones. So if there are any companies you have on your list you're watching for the next couple of days, let me know, inshallah. I might actually put a quick videos together just to go over their earnings and so on, inshallah. Anyway, that's the 9 companies I wanted to share with you guys today. Have a wonderful day. Assalamu Alaikum.